Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Friday, December 30th, 2022. Happy New Year to everyone, and I hope you had a good 2022 and an even better 2023. What happened in the market this year? I know we have a few hours left until the final bell rings, but clearly a different market. Just alone on the S&P 500, we see a retreat. We're talking at this point roughly down 18, 19%. Clearly a contrast over the last few years, and we really have to go back to 18 to see the last decline in the S&P 500. Also, we have a repeat champion this year for sectors. We have energy coming in up 15%. But within the sector competition, we see quite dispersion going on. If we look down at the bottom of the table for performance, we see telecom down 33, discretionary down 32, compared to consumer staples, which is just down 2, and healthcare just down 1%. So pretty wide disparity. So in a sense, a stock pickers or a sector pickers market. And I think that is again something we will actually look towards next year as there continue to be concerns about earnings. I think we have to look deeper down into the sectors to think about different opportunities as we move forward. And also, I think that's on the international side. For the first time since 16, we actually see the Canadian market outperforming the US market. And actually, the US market was kind of lackluster compared to better performances we saw throughout the world. Brazil doing well with an election there. So again, some signs of international commodities were stronger. That sort of favors the emerging group. Developed countries have sort of moved beyond. We've seen higher interest rates telling us that economic growth seems to be coming. And just recently, we've seen some uptick in certain numbers, not everywhere internationally, but as we see China coming out of its COVID lockdown, there are opportunities here, but clearly risks as we move forward. And another major story in the year was long treasuries, almost a 30% year over year total return decrease, a sizable move, and one of the worst performances we have seen. And clearly, that bull market that was raging with lower inflation has exited. So that mix, right, where you would expect the 60-40 portfolio, that 40% of bonds to hold up when you have a bad equity market, is sort of dissipating as interest rates are finding a new level. What's the component of that new level? Inflation is clearly a component, probably long-term now higher than what we'd expect. We're not talking 4 to 5. We're probably talking near 3 compared to the 2% we saw before. But we're also seeing real returns. That's the difference between nominal and the inflation element higher. So the demand for money is actually stronger, and it's actually encouraging to have real interest rates above 0. And we actually think that's constructive. Now, we have productivity issues, we have federal deficit crowding out issues that will limit some of the natural growth and the growth of demand out there for that affects interest rates. But it's not going to be that always lower interest rates over the long term that we've seen. So that's a sizable change. So 2020 was clearly a watershed event. We saw disparity in the sectors that were wider than normal. We also saw international doing well for the first time in numerous years, and we saw poor performance, particularly on the bond portfolio. Future does not indicate from the past. However, these are worthy of notes as we approach 2023. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.